Once again, thank you to our attendees for joining us today. As the title entails, we will be discussing the tax landscape and developments in Oman. As a brief introduction, my name is Ahmed Barawani, and I am a partner and the head of Oman office. I am joined today by my esteemed colleague Shiraz Khan, who is a partner and head of tax, Ioannis Nanos, who is the transfer pricing advisor in our tax team, Janet Gooi, who is a senior associate in the tax team, and Qasim Hussein, who is an associate in the tax team. Moving on to what we will be covering today, we are focusing on the current tax landscape in Oman, and we will discuss the tax developments and updates that you should be aware of, as well as the key consideration in tax audits and disputes. Next, we'll be provide you with some practical lessons based on a real-life experience and common issues faced by taxpayers. We will then provide you with insight into what business should do to manage tax risks. Finally, we'll open the floor for Q&A session with the audience. Before we get into the topics today, we have a few housekeeping items to remind you of. First, we'll record this session and share the recording. Secondly, should you have any questions, please use the Q&A function at the bottom of your screen to post such to the speakers. Thirdly, to make this session more lively, we have included a number of polling questions, so please be ready to partake in such. Finally, if you face any issues with hearing the speakers, please ensure you have connected the audio by choosing either connect through your computer or phone audio. We will start looking at some of the current tax landscape in Oman. To get a better idea of our audience, we have our first polling questions. How important do you consider the tax risks are for your organization? We will give everyone about a minute to answer the question. So there are three options, very important, somewhat important, and not important at all. So the percentage is about 77%. Looking at the results, it appears the majority of you find tax risks to be very important for our organization. Therefore, we would like to emphasize that tax risks should be at the forefront of any business mind and ensure that it's compliant with the relevant regulatory framework. In Oman, there are three main areas of taxation, as you may know, which is in corporate income tax, value-added tax, VAT, or withholding tax, also known as WHT. Corporate income tax refers to a direct tax imposed on the income or capital of corporations and business entities. In Oman, the corporate income tax is applicable to Omani companies and permanent establishment, except for the small and medium-sized enterprises, which are taxed at 3%, and petroleum sales, which are taxed at 55%. All other companies are taxed at 15%. There is an exemption to the tax for any gains made from the sale of listed shares and dividends by Omani companies. In relation to the value-added tax, it is a tax on goods and services and came into effect on 16th April 2021 in Oman. There is a standard rate of 5% for any goods and or services sold. For basic food items and exports, there is zero rated tax, and financial health care and other services are exempted from VAT. Companies and individuals who sell goods or services must register with the tax authority. The registration fees are dependent on whether registration are mandatory, for which the fee is about 38,500, and voluntary, for which the fee is 19,250. Under that, there is a quarterly filing requirement, which is done with the tax authority in Oman. In relation to the withholding tax, it is a tax whereby the payer must withhold the tax and remit such to the tax authority in Oman. It is applicable at the rate of 10% to non-residents for dividends, interest, royalties, technical fees, and Omani-sourced management fees in relation to research and development, as well as use of a right to use computer software. By way of an example, withholding tax is payable within 14 days of the end of the month in which the tax is deducted. Other tax regime in Oman include stamp duty, which is at 3% on the property transfer fees, customs duties, which is at 5% tax on imported goods, with exemption from certain food items, medical supply, and other items, and excise tax, which is at 50% tax on sugar, carbonated drinks, and 100% on tax on tobacco, alcoholic beverages, and energy drinks. Now that you have a basic understanding of the current tax landscape in Oman, I'll pass the floor over to my colleagues, Qasim, to provide an overview of the tax developments and update in Oman. Thank you very much. Over to you, Qasim.
Thank you, Ahmed. That was very helpful. I guess there recently have been certain developments in respect of tax in Oman. Specifically, what we'll be looking at today are the incentives provided by the economic stimulus plan in Oman. Also looking at the recent VAT, excise taxes, international taxes, and development in respect of personal income tax as well. Specifically, the economic stimulus plan was introduced as a form of relief for businesses in Oman, and also to stimulate the economy and move it away from oil and gas. But it also covers certain reliefs or exemptions in respect of tax. This includes corporate income tax exemption that was introduced specifically for businesses that were targeted at diversifying the economy, such as the hospitality business, the logistics and manufacturing business. The corporate income tax exemption for companies were introduced in 2021 to 2022, and there were also a corporate tax exemption introduced for hotel establishments, which were exempt from income tax due for tax years 2020 and 2021. The other reliefs that were provided as part of the stimulus plan were in respect of payments for tax. Certain taxpayers that settled the income tax in 2021 installments were allowed to do that, and no fines were payable for these taxpayers. For those taxpayers who made the payments on time, there were reliefs provided in form of a reduced tax rate of 12%, and then 1% rebate was also provided on the tax liability up to a maximum of 10,000 Omani reals as well. Tax losses were also allowed to be brought forward for a period of 5 years rather than being restricted, and this was an incentive available. Other than that, withholding tax was initially suspended for 3 years in May 2009, and the economic stimulus plan extended that suspension for a period of 5 years until 2024. Next, as Ahmed mentioned, the VAT was introduced in Oman in April 2019. Since the introduction of VAT, the tax authorities and the government have provided helpful guidances on VAT, and these guides include items that are subject to zero rated or that are exempt. They also provide helpful guidelines for the oil and gas sector, the financial services sector, and provide information in respect of what the registration thresholds are and when these should be met and when the businesses would need to then register for VAT. The guidelines also provide information in respect of free zones and clarify that certain supply of goods and services into and from within those free zones may be subject to a rate of 0 rather than the standard rate of VAT. The oil and gas guidelines were published recently in January 2002, and one of the key areas it clarified was that certain midstream and upstream activities performed by gas companies would be subject to a rate of 0% VAT rather than the standard rate, and that was quite useful for some of the businesses. Other than the VAT developments, there have recently been excise developments in Oman as well. Excise was introduced in June 2019, and certain products, as Ahmed mentioned, such as tobacco, derivatives, energy drinks, special purpose goods such as alcohol and pork were subject to excise tax at a rate of 100%, while carbonated drinks were subject to excise tax at a rate of 50%. The tax authorities also published guidelines that were in respect of implementation of excise tax, and at the time it provided clarity in respect of the amount of excise tax that would be applicable on goods and manufactured products that were already in Oman at the time. Also, there's no registration threshold for excise tax in Oman. Any person involved in or has the intention to be involved in producing or importing excise goods are expected to register. Next, we're looking at the recent international tax developments in Oman. And to ensure that Oman meets or is in line with other jurisdictions in the Middle East region in respect of OECD's developments regarding base erosion and profit shifting, Oman has introduced the corporate country-by-country reporting requirements in January 2020. And these requirements deal with local filing requirements for multinational groups that are headquartered outside of Oman. And although these were suspended until further notice, there are certain obligations that still continue to apply, such as the notification requirements. Oman also signed the multilateral instrument in July 2020, although the instrument is yet to be ratified. Further, the Central Bank of Oman implemented the Common Reporting Standards regime in Oman, setting out the rules for the automatic exchange of information. And I guess the probably one that has the most impact on businesses right now is the BEPS 2.0, which brings Oman in line with the inclusive framework, and it ensures that Omani groups with an effective tax rate of less than 15% would have a cash tax impact. And the way that works is that certain businesses with a global consolidated revenue of 750 million would be subject to corporate tax in other jurisdictions at a minimum rate of 15%, because those jurisdictions would be also introducing corporate tax to ensure that they're compliant with BEPS as well. Other than that, Oman is also looking to introduce the personal income tax in Oman. Right now, the only tax applied on income tax is social contributions made by employees and also employers. This is at a rate of 17.5% and payable on salaries to Omani nationals only. However, the PTI regime is being evaluated by the government. And following its inclusion in the 2020-24 medium-term fiscal plan, it's expected that the government will introduce personal income tax on the salaries of individuals in Oman. Although further information is yet to be published, it's expected that the rate might be around 7 to 9%, and this is subject to confirmation. And I'll hand this stage over to my colleague, Ioannis.
Thank you, Kasim, for this. It has been, very helpful to hear all this about the background in Oman. And I think we are living in an environment that tax landscape in Oman, but also not only in Oman, but in the whole region, I think it's changing quite quickly. We notice that similar changes are also happening rapidly in the world of transfer pricing. So to start with, Oman has included transfer pricing legislations in the in the Omani income tax law. Specifically, there is a concept of arm's length principle. There is a definition as well of related parties. In the income tax law in Oman, basically the definition on related parties specifically mentions that transactions between related parties should be conducted in the same way that these transactions should have conducted if these parties were independent. So we can see that a core concept of transfer pricing, the arm's length principle, is part of the legislation of the tax legislation in Oman. However, a very key and important factor here is to mention that there is no specific transfer pricing guidance with regards to TP documentation. What does that mean? Is basically that the income tax law does not include guidance on what is the, let's say, the content of TP documentation, or what should be the approach or the methodologies to test and evaluate and also assess related party transactions. So just to keep that in mind, that is very important. It's part of the overall picture on the transfer pricing landscape and tax in general landscape of Oman. However, as Kasi mentioned previously, Oman is part of the BEPS inclusive framework. So that basically means that they have to comply with the minimum standards, the BEPS minimum standards. And part of this is the country by country reporting that already has been part of the law in Oman. So basically, as Kasim previously mentioned, multinational groups with a specific revenue threshold is basically above 300 million Omani rials, around 750 million, 780 million USD dollars. They need to have to prepare CBCR report and as well the CBCR notification. The CBCR report has been suspended for groups that are headquartered outside Oman, but still remains for groups that are headquartered in Oman and they are above the threshold. So together with the country-by-country reporting, that is one pillar of the three-tiered TP documentation, there's still the local file and the master file. Still, there is no guidance and with regards to transfer pricing if the local tax authorities will follow the guidance from the OECD, but it's highly expected because they have already introduced country-by-country reporting, and it's very likely they will also introduce local file and master file requirements, similarly to what other countries in the region have already done. That's, I think, a quite important side to think about the TP documentation, and as well it creates a bit of ambiguity because we have noticed that the tax authorities in Oman, they are quite aggressive in terms of, tax audits, and part of the tax audits remain the question around related party transactions. So it's always important for taxpayers to prepare and maintain TP documentation, even if it's not a mandatory requirement to submit it. The concept of arm's length principle is part of the law, so effectively the whole, transfer pricing concept is part of the income tax law in Oman. So that basically requires for taxpayers to prepare and have a proof that they have, priced their related party transactions in line with the arm's length principle. The ambiguity is created here that there is no specific TP guidance on how to price these transactions, on how to prove that you are on arm's length. So I think we think as a best practice, basically, to maintain TP documentation in line with the OECD guidance, follow the approach that is followed by as well by the OECD members, and just for all taxpayers and the people that are basically in the webinar today, they should not take TP lightly in Oman, because as we mentioned, arm's length principle is there. Country by country reporting rules already exist. TP documentation in the shape of a local file and master file most likely will also be implemented quite soon. It needs to be still seen how. And also on top of this, we need to also to keep in mind that tax authorities in Oman, they're quite aggressive with regards to tax audits, and a key part of this is basically as well related party transactions. With this, I will hand over to my colleague Janet, that I think she will talk more about the tax audit landscape in Oman.
All right. Thank you, Ioannis, for the helpful overview of transfer pricing. Could we just go back to the previous slide, please? All right, thank you. So as you've heard from my colleagues, Kasim and Ioannis, the tax landscape in Oman has been changing rapidly over the past few years. You'll see that there's lots of developments on the corporate tax space. VAT is introduced now in Oman, and excise tax as well, and with personal income tax on the horizon. All of this, is actually signifies the need and the increased focus on tax collection, in an attempt to actually diversify revenues of oil and gas. And this is not just limited to Oman, but regionally, because of the impact of COVID and the increase in interest rates as well. There's increasing scrutiny that taxpayers are facing now from tax authorities in Oman. And inevitably, as tax systems mature in Oman as well, you would find that you would inevitably find yourself, with a tax audit. You're facing a tax audit from the tax authorities, or you may have gotten an assessment from the tax authorities recently and find yourself embroiled in tax disputes in Oman. So hopefully in this session, you would take away some practical aspects that you need to consider, when you're managing tax audits and disputes, so that you can align your stakeholders and also manage this process effectively. So before I go into that, I have a poll question for you. So how many of you are prepared to handle a request for a tax audit or tax-related information request from the Oman Tax Authority? So you have three choices. Are you well prepared, somewhat prepared, or not prepared at all? Okay, so it seems like a majority of you are somewhat prepared to manage a tax audit or tax-related information requests. About 26% of you are well prepared, which I assume you've previously gone through similar exercises in other countries as well. And 16% of you are not prepared. Well, hopefully in this session, you take away, some of the key aspects that you really, need to consider when managing the tax audit or disputes. So typically, the tax authority has the power to request for certain information from the taxpayer. And usually when this happens, this signifies, the start of a tax audit. And as a taxpayer, you have the obligation to actually, respond to requests from the tax authorities. Now, usually this would happen first as a type of desk audit. So usually tax authorities may reach out via email and you get a request, requesting for certain information. Now, if the tax authority still remains unsatisfied, then they may then proceed to conduct a field audit, which is when they actually decide to visit your premises to investigate, all this tax-related information further. Now, it is important to understand, what are your rights and obligations as a taxpayer and what the tax authorities can and cannot inspect, and how much notice can they actually give you before they decide to visit your premises. Now, the tax authorities can only conduct audits at your premises during normal working hours. So if you, receive a surprise visit outside working hours, then you can reject their request. Now, tax authorities need to give you at least 10 days notice before the date of inspection. And this notice needs to specify the date and the time of visit, the tax years that are subject to inspection, and the documents that are required for inspection. However, as an exception, the tax authority is able to, visit unannounced where they suspect that, there's tax evasion involved. And what sort of documents can tax authorities inspect? They can inspect any sort of documents, information, data, records relating to tax obligations in the tax year, within a span of 10 years prior to the current tax year. Now, this corresponds, of course, to your obligations, your document retention obligations as a taxpayer, which in Oman is 10 years. So you would need to retain all these tax-related records, going back to 10 years. Interestingly, though, the statute of limitations in Oman is actually only 3 years, and this can be extended to up to 5 years, where the tax authorities, suspect tax evasion. However, there seems to be, a heavier obligation on taxpayers to actually still retain these records for 10 years. Now, once the tax authority has completed its inspection in your premises, then, the tax authority can decide whether to close the case, and they're satisfied with their findings and they don't, find any irregularities within the company, or they can decide to actually issue an additional tax assessment. Now, they need to notify you within 2 weeks of, the date of making that assessment. Next slide, please. So in the unfortunate event that you actually do get, you receive an assessment, it's also important for you to understand, the whole tax dispute process in Oman. By having a good understanding of, the various stages of appeal, you'll be able to manage, the budget for your tax disputes more effectively, and also align, your stakeholders' expectations as well. Because a tax dispute, as you know, involves a lot of time and effort, and it can also be a very protracted process in Oman. So when you receive an assessment, the first thing that you need to do is, you have 45 days to actually appeal by submitting an objection to the tax authority. So within the 45 days, you need to, consider whether you need to, involve tax advisors in this appeal process. Consider what items you want to object against and what are your grounds for doing so, and before submitting it to the tax authority. Now, once the tax authority receives that objection, they have 5 months for them to actually consider, accept or reject certain items on that objection. Now, this period of 5 months can then be extended to a further 3 months for them to actually come to a decision. Now, it is important to actually keep track of this timeline, because just because the tax authority doesn't respond, within this 8 months, that does not mean that, the issue is done and dusted with. You actually need to keep track because this means under Omani tax law that is a deemed rejection. And what that happens next is that if the tax authority issues its decision on your objection, you have 45 days from the time that you were actually notified of the tax authority's decision to appeal to the Tax Grievances Committee. Or alternatively, if you don't receive a decision within 8 months, then you have 45 days from the 8 months from the tax authority's time to decide on the objection to submit your appeal to the Tax Grievances Committee. Now, in 2020, Oman issued a resolution to actually form it's not a new committee, but it's essentially previously before the introduction of VAT, the Tax Appeal Committee was just overseeing, income tax disputes. Now, in 2020, this resolution then changed or reformed this committee to actually extend the powers, renamed it to the Tax Grievances Committee, and also now they oversee VAT, excise tax, and also income tax disputes. The resolution also specifies the working of the committees and how they should actually review your appeal. What is interesting, though, is that they've not actually specified a timeline for the Tax Appeal Committee to actually issue their decision. So, as a taxpayer, you also have the obligation to always proactively follow up. If you have not heard from the tax authority or the Tax Grievances Committee for a while, you should always proactively follow up to see if you get a decision soon. And now, once the Tax Grievances Committee actually issues their decision, you have, sorry, there's a typo there, but it should say 45 days. You have 45 days from the notification of the committee's decision to actually appeal and take it to the courts. Now, at the court level, you have 3 different levels. First of all, you have the court of first instance that will hear your case. And if you're still, you still receive an unsatisfactory decision, then you have the right to further appeal to the Court of Appeal. And if the Court of Appeal still rejects, unfortunately, your case, then you have the right to take it up to the Supreme Court, which is the highest appeal level. Now, the decision of the Supreme Court remains final and it's unchallengeable before any other judicial forum. So this is the highest form of decision that you will receive. And looking at the entire process, I think the key takeaway from this point is that, look, as a taxpayer, you have the rights of appeal. If you don't pursue your appeal at any stage, if you don't pursue it further, then the decision will be final at that stage. So it's always important to consider to bear this in mind, when you're going through this process. Next slide, please. Now, some of the practical aspects that you need to think about when you're going through this whole tax dispute process is, first of all, do you have the proper authorization provided to your legal representatives? As basic as it sounds, we've seen companies that get entangled up with issues like this, particularly in this region where a lot of the tax committees and courts place lots of emphasis on having the proper form, going through the actual satisfying all these procedural formalities. So it's always important to first of all look at whether you have a proper authorization that's been granted to your signatory. Does he actually have the power to delegate or appoint legal representatives for the company? The second issue is that we find that usually for branches of foreign companies, they get into a bit of an issue when the authorized signatory is actually based outside the country. For example, if it's not sitting in Oman and he needs to grant that power to the local branch, then what happens is that you need to factor in the amount of time it takes for the power of attorney to be attested outside Oman and go through all the relevant certifications before it's brought into Oman to be legalized. So This is one important factor that you should take into account and not fall into this trap. Now, secondly, by going through the whole dispute process, that does not mean at all that your tax, your taxes, the tax that you're disputing is suspended. So the minute you get the tax assessment from the authority and you appeal against it, it still does not suspend the amount of tax that is assessed by the tax authority. And even at every stage, at the objection to the tax authority or the appeal to the tax grievances committee. Now, the way to go around this is that you actually need to, once you submit the objection to the tax authority, you need to separately make an application to suspend the disputed tax. And then the tax authority can then actually decide, can they reject it, or they can decide to accept it. And if they do accept it, they usually may ask you to provide a bank guarantee, because at the end of the day, the tax authority is interested to collect the tax that they have assessed, right? And because the tax dispute process is so protracted, anything can happen, as the taxpayer and the tax authority goes along this this entire dispute process. The company could either be bankrupt along the way, and in the end, even if the court decides in favor of the tax authority, maybe the company may not even have the money to pay the tax authority in the end. So it's also important to always bear this in mind and make a separate application to suspend the disputed tax. Coming on to the next point, it is crucial, very, very crucial, to bear this in mind when you're appealing to the tax authority or committees or the courts, because the courts, the tax authorities, they all place a particular emphasis on satisfying procedural formalities in this region. So the minute you file an appeal that's out of the statutory time limit, then that means that your case wouldn't even be considered based on the merits of your case. So even if you have a very strong case, that will be argued in favor of yourself, if you don't file within the prescribed time limit, then your case is out. And when that happens, you're going to find yourself in a very difficult situation to actually overcome this procedural hurdle first. And so importantly, and in addition to this point as well, that goes to the point of the deemed rejection period. Just keep track of when the tax authorities actually respond to your objection, because in that 8 months, the minute that 8-month period has lapsed, your right to appeal would have also lapsed. Now, on the fourth point, strength of your case, it's also important to assess, how strong your case is. And a good tax advisor and law firm would always tell you, which items are in your favor and which ones, you have a case to pursue. And that also would then dictate how much effort and energy you would actually, spend on arguing your case, because you have to balance, the cost of litigation as well versus the cost of the items that you're disputing. And this all ties it back into managing your budgets more efficiently. Now, on that note, consider as well alternative dispute resolution. Now, the Omani tax law specifically says that arbitration is not allowed in tax disputes, but you could explore settlements with the tax authorities. Now, usually in this case, this would help to achieve a quicker resolution between the tax authority and yourselves. However, you need to bear in mind that this is always just limited to the assessed years in question. So let's say they assess you for 2015 to 18, then your settlement would then just be limited to the periods in question. And just bear in mind as well that this does not prevent the tax authority then from coming to you for the later years. So they can always come back to you in 2019 onwards on the same issues because that would remain unresolved. Next slide, please. Yeah, so coming on to the common issues that are faced by taxpayers, and also some of the lessons that we've learned around the region. Next slide. Yeah, I think the first and primary issue that we see is that tax is usually not the top priority for an organization. And when that happens, then you don't have the sufficient resources or the sufficient budget to deal with tax issues in the company, when in fact tax actually affects most aspects of an organization. If you're undertaking a restructuring, you need to consider what are the tax aspects when you restructure, when you transfer assets to another company, the capital gains, is the VAT impact, all these needs to be taken into account. So that needs to be at the top of the agenda as well, so that all the stakeholders are aligned. You need to get your legal finance teams involved in all these discussions. Now, secondly, we've also seen, and not just limited to Oman, but there is an unclear understanding of tax legislation. When Oman has just recently introduced VAT. So previously, even in the GCC region itself, there was no VAT, there was no indirect tax, there was no excise tax. So, people, organizations have not really dealt with indirect tax in the past. So there was a lot of uncertainty in many areas of the law. But hopefully, because VAT has now been implemented in UAE, Saudi, Bahrain, you could actually also take guidance from these jurisdictions as well to sort of fill in the gaps where the Omani VAT legislation has not actually dealt with it. It is also important to ensure that everyone in your organization understands at least, or has tax in their mind, when they undertake a certain activity. And it also helps when you send your tax team for workshops and webinars to keep abreast of all these tax developments in the region, as well as Oman. Now, the third issue that we commonly see, and this also ties back to my earlier points, is that there is insufficient tax expertise usually within the organization. So sometimes organizations do not dedicate enough resources to actually deal with the tax matters of the company. There's no one size that fits all, really. So you just need to consider whether your tax requirements are best met through having an in-house team that just handles all the tax matters, or you outsource your tax obligations and have someone to actually coordinate these matters, or a hybrid. So you have a tax team, and you also work with your tax advisors to meet your tax obligations. Now, the fourth one, there is also, we've seen, insufficient tax controls in organizations, the lack of tax policies, and also the absence of tax risk and dispute strategy. So I think the first key takeaway is just that documentation is just so important. When you have your related party transactions, for example, you need to be able to demonstrate that the price or whatever price that you've agreed on is at arm's length. And also, if you're claiming deductions for tax purposes, then you need to actually have the documentation to back that up. And because your document retention obligation extends to at least 10 years, it's important to have all these records organized so that whenever you're faced with an audit request or information request from the tax authority, you can easily just extract that information because it's organized and you know exactly where to find it or who is the person in charge to actually give you that information. And you don't get stuck in that process of actually scrambling to find all this information when you're requested to do so. And also having a strong, risk and dispute strategy would then help you to, manage your disputes more effectively. Also important to have all these tax policies in place, and also advice from your tax advisor on, on certain tax positions, so that when your company actually takes a tax position, It is all documented. The basis for it is there. So whenever you're going to define your tax position, you can also say that, look, this is you have a strong basis for maintaining this tax position. And with that, I'll hand over this session to Shiraz.
Thank you, Janet. Good morning, everyone. So I just wanted to start with letting you guys know that I was very encouraged to see some of the responses to the poll questions. So I think more than 70% of you said that you, within your organization, tax risk, and also more than 70% of you said that you're, highly prepared or somewhat prepared in the event of a tax audit. So that was very, very encouraging to see. I've been in the region now for more than 10 years, and I can tell you when I initially came to the region, my expectation would have been that the responses to those questions would have been a lot lower. And that's because at that time, tax wasn't high on the agenda, and tax has of course become increasingly important, globally and in the region. There's lots of international tax developments which are happening, which are impacting things in Oman. And also there's a lot of things happening in the economy globally and in the region, which is resulting in, more scrutiny on taxes, new taxes being introduced. Historically in Oman, of course, there was just corporate tax, which has been there since the early 1970s. And of course, there's been amendments over the years, but pretty much the taxes were limited to corporate tax. And then more recently, as my colleagues have said, excise tax was introduced in 2019. VAT was introduced in 2021. And as my colleague said, this is part of a drive to actually diversify away from oil and gas revenues and to generate additional tax revenues. This is very common in the Western world. In this part of the world, there's been a lot of reliance on oil and gas revenues, and I guess the focus is shifting now. And what really started this shift was the decline in oil and gas prices in 2014, 2015. Prior to that, there was obviously a lot of money being generated by countries from hydrocarbons. And now the focus has completely shifted to actually generating money through taxes. And I think that, with all these changes happening, we have obviously a very old tax, the corporate tax. We have lots of new taxes. When a new tax is introduced, very often the first stage of focus is the implementation of that tax. So businesses usually want to understand, what is the tax about? Does it affect us? Does it apply to us? If it applied to us, what are our obligations? How will we be impacted? Could we do things differently? And how do we set up to comply with this tax? So this is all part of implementation. And of course, we saw that with excise tax. We saw that with value added tax as well. And then once a tax is introduced, businesses need to focus on, registering for tax and then, complying. So there'll be a requirement to comply, file tax returns, pay the taxes. And you, of course, need to have a good understanding of the legislation in order to be in a position to actually comply. Once the compliance is there and you've submitted your tax returns, then the focus and the onus shifts on the tax authority. So you submit your tax returns, and the next is almost an audit stage or inquiry stage where the tax authority focuses on asking questions. They may undertake an audit. And depending on the consequences of that audit, the tax authority may issue additional assessments for you to pay additional taxes, which could result in a dispute. And of course, the dispute may then be litigated through the committee, the courts. So these are the broad processes. Now, in terms of where we are with corporate tax, that's obviously been there for quite some time. So there may be some uncertainty in relation to corporate tax, as well as the new taxes. I mean, even though corporate tax has been there for a long time, there's still some provisions which are open to interpretation, and they're being the subject of dispute, and they've been litigated on a daily and weekly basis. I think generally in Oman, the legislation is quite brief. In some of the Western countries, if I look at the UK, for example, if I was to stack up the legislation from the floor, it'd probably come up to here. And if I was to then stack up the case law on top of that, we would probably be talking about hitting the ceiling. Now, in the region, the legislation is very, very brief, in Oman as well. And also there's a very limited case law precedent, and often this case law is not available to the public. So there are some challenges. There's this brief tax law, which can be interpreted in different ways. The tax authority often take an approach which is not aligned with the legislation. And there's a lot of things which happen in practice, which have not been codified in the legislation. And there's not too much guidance to rely on. So therefore, in Oman, there's a lot of risk of tax disputes happening. So this is something that you need to be conscious of. Also, value-added tax and excise tax, these are, of course, new taxes. And, you know, it's only been 1 year since value-added tax was introduced, for example. And if effectively, a lot of companies, they scrambled to understand how it applies to them. And then they started filing their tax returns. And the Oman tax authority has been there for a long time, but initially their focus historically was corporate tax. Now, value-added tax being a new tax, they had to increase their resources. So it will take some time for them to audit you. If they decide to audit you, they probably have challenges in terms of resources. So over the next year, 2 years, you could expect an increase in audit activity, where the Omani tax authorities will review your returns. Quite often, a lot of businesses make the mistake of thinking that, okay, we submitted our tax return, nothing has happened, everything is perfect. And then they hit with a tax assessment or tax audit. So sometimes things can happen from nowhere. So it's very, very important for you to manage your risk. In terms of risk management, of course, there'll be someone, it may be a function, it may be the legal function, it may be the finance function, it may be the tax function, it may be a particular individual. You'll be responsible for complying with the taxes. And if there's any issues, it's your responsibility to make sure that everything is in order. So you're going to have to explain to the management internally, as well as defend the position. So it's very important to, if your organization doesn't have that type of person, to make sure there is a person who's responsible for taxes and to manage the taxes. It's also important to have a tax policy in place which defines the risk appetite of your organization. Is your focus compliance? Are you looking to make some tax savings? And what kind of risk are you prepared to take? And in terms of, depending on the value of the risk, what kind of approval levels will you have within the organization to manage that risk? And, you know, for example, if the amount is above a certain amount, maybe you want to get external advice. So it's very, very important with all this uncertainty, unclear legislation, new legislation, to actually manage your tax risk and understand where the uncertainty is. And if there is some uncertainty, you could take an opinion from an external tax advisor, which you could document. And this could be used as a defense before the tax authorities. And it could also be used as an internal defense for you within your organization, that you did take some measures and you took a position as an organization based on external advice. So these are areas where you could actually, you know, make a difference by effectively identifying the risks, managing them, and addressing some of the uncertainty. I think, as Ioannis said as well, transfer pricing is becoming increasingly important in the region. And whilst there's no specific transfer pricing regulations in place, there are some transfer pricing rules in the income tax legislation. And historically, the Oman Tax Authority haven't been too focused on transfer pricing. But now with the region and also the Oman Tax Authority, they're increasingly focusing on transfer pricing. So they understand that, you know, related party transactions can be, the price can be manipulated in a way which minimizes the tax. So therefore, we could expect, you know, in due course to see perhaps more detailed rules, and whereby Oman introduces documentation requirements in line with some of the other countries that we've been saying, like Egypt, Saudi, Qatar. So this is a development which is going to happen in the future. And as Janet said, I think tax disputes are very, very important as well. So you need to be prepared before the dispute starts, and also manage the dispute once it starts. And as I said, in terms of being prepared before the dispute starts, you just need to identify the risk. You need to document it. You need to see if there's measures you could take to minimize the risk. And this could only happen if you proactively manage the tax risk and don't wait for an audit to start or litigation to start, because I think at that stage it'll be too late. So the key message really is to start early, to think about what you're doing. Although you've been doing it for 10 years, you may have been doing it wrong. And the consequences of that could be quite severe. In some cases, it could result in the shutdown of your operations. Because if you think about it, 10 years of historical tax exposure, and compounded by penalties which will be applicable, the exposure can be very significant. In some cases, it could be 20 years because you don't know. Of course, there is a statute of limitation, but that could also be extended, as Janet mentioned. But the point is that the exposure can be quite high, and you can manage the tax risk by identifying the issues early. Even if you've been doing something for several years, you could actually undertake a health check just to check that, because there's lots of changes in the legislation, there's lots of developments which are happening. Sometimes the people at the tax authority change. And when the people change, it results in a change in approach by the tax authority. Previously, they had a certain practice and certain approach. Now, all of a sudden, they have new people who think about issues in a very, very different way. So therefore, you need to make sure that you're up to date with everything, you keep abreast of the developments, and you undertake this health check just to make sure that everything is in line and you haven't been doing something wrong for the next 10 years. And at the very least, it could help you manage your risk going forward. So although you've been doing it wrong for the past 10 years, you could identify it now and address it going forward. So I think these were the key messages, and it just comes on to our last slide. So, Al-Tamimi & Company, we're the largest law firm in the Middle East. And we also have the largest tax practice at any law firm in the Middle East as well, and North Africa. And we're happy to assist you with everything on the advisory side and also the litigation side. We've been involved in a lot of tax disputes across the region, and we have a lot of experience in helping clients, and we're highly specialized in this area. So it's good to involve us at an early stage where we could actually guide you and help you mitigate some of the risks. And then if there's any issue arises, well, we could represent you as well. We have a full service tax practice, so we'd be pleased to assist you. So I'm conscious that there's only a minute left, and so I think there have been some questions here, so we'll try to get through some of them for now. And any other questions, we'll respond to you by email. I think that someone's asking, will the presentation be shared? Yes, we'll share a copy of the presentation and also a link to the presentation as well. So in terms of the first question, Ioannis, the question's for you. So in terms of transfer pricing, how soon do you expect Oman to introduce specific documentation requirements?
Yeah, that's a very good question. I mean, it's hard to say, to be honest with you, but I think it's going to be sooner than later. I mean, what we have seen also in the region in terms of, the BEPS developments 1.0, now we have BEPS 2.0, Pillar 1, Pillar 2, minimum effective tax rate at a global level. So I think because the global tax landscape has changed quite rapidly the last years, and also what we see in a regional level. I mean, UAE has recently announced that it's going to introduce income corporate tax, and as well transfer pricing will be introduced as well in line with OECD. I think looking at UAE, it's a very good example for Oman as well, that basically I cannot really set a timeline on this, but I don't think so it will take too much time, because there is this growing trend, and also it's a growing trend not only on a global level but also on a regional level, that we see a lot of countries here have basically introduced transfer pricing documentation requirements. We saw like a few years ago Saudi with a full-fledged TP documentation. Egypt has in place for a number of years now. As well, recently, Qatar has implemented specific transfer pricing documentation requirements. So I think it's very likely in the next few years that Oman will also follow.
Well, thanks, Ioannis. I mean, I wouldn't be surprised if it's sooner than that. I think transfer pricing is a very evolving landscape and it's moving very, very fast. I'm conscious of the time, so just one more question. And the question is for you, Janet. What are the key challenges have we seen in tax disputes?
Yeah, I think I've addressed some of these key challenges as well. In tax disputes, it goes back to the point of, first of all, I think a lot of companies sometimes, when you have document retention obligations of over 10 years, the company tends to have records all over the place. So in the end, although they have strong legal grounds to dispute something, some of the pitfalls that we see are the company then unfortunately cannot be able to back it up with factually because they don't actually have the records to substantiate their arguments. And so because the disputes here as well, they place a lot of emphasis on documentation. It's just so important, for companies to be organized in the way they document their tax positions and also have that supporting documentation to substantiate the positions.
Yeah, no, thank you for that, Janet. Yeah, as you said, I think the key issues when it comes to disputes, even in order for you to be represented, you need to have a power of attorney. And a lot of people aren't focused on, how they could be represented, and therefore they won't have any representation at the time of the hearing. I think the other issue was, as you mentioned earlier, timelines. A lot of taxpayers, they're not because there's a deemed rejection. So it's very important for you to get your appeal in, because if you don't submit your appeal on time, you have no right to appeal. I think the third thing, as you said, documentation, very, very important. Sometimes you could have a strong case, but it's not supported by documentation. So although in theory you have a strong technical case, but you cannot support your case. So these are, I think, some of the important items. And again, I'm conscious of the time. So thank you very much for taking the time to attend the presentation today. As I mentioned earlier, we will be sharing slides with you and the link to the presentation. Feel free to send any questions by email. We will get back to you on the questions that you've asked and we've been unable to respond in today's session. Thank you, everyone.